Welcome to the deep dive. This is where we take, well, frankly, huge stacks of research and boil them down into something useful, something actionable.
Hopefully.
Hopefully. And today we are definitely diving deep into a technology that's done something, almost unheard of. It's basically sparked a socio-economic revolution, and on a massive scale. We're talking about India's Unified Payments Interface, which everyone just calls UPI.
That's right. And our mission today, over the next half hour or so, is to really go beyond the surface. We want to unpack UPI not just as another payment app, because it's so much more than that.
Absolutely.
It's become this benchmark for what we call digital public infrastructure, or DPI. So we'll dig into its architecture, which is quite unique, the economics, which, let's be honest, has some tricky aspects.
Definitely some tension there.
Yeah, the governance structure, and how it's starting to spread globally. And we're sticking strictly to our source material here, our research.
And look, before we get into the how and why, we just have to pause and look at the sheer scale of this thing. It's the wow factor. It really sets UPI apart from, well, pretty much any other fast payment system out there.
It really does.
The numbers, as of mid-2025, they're just staggering. This isn't some slow, gradual thing. It's operating at a level most countries haven't even, thought about aiming for yet.
Yeah, it's an operational phenomenon, really. We are talking about a system processing, get this, over 14 billion transactions every single month.
14 billion with a B.
Per month. To give you some context, that kind of volume, it's almost like the entire annual volume of several major European payment systems combined.
That's incredible. 14 billion payments flowing through this one standardized system every 30 days or so.
Precisely. And in terms of value, that translates to roughly INR 22 trillion monthly.
Oh.
But, what's maybe even more impressive than the raw volume?
The reliability.
The resilience, exactly. The transaction success rate is consistently over 99.8%. Think about that complexity, that volume, and it just works. And it's serving currently about 300 million unique users, plus, and this is key, over 50 million active merchants. It's that reach into the smallest shops, the street vendors. That's where you see the real shift in economic behavior.
And you compare that to, say, FedNow in the US or Pix in Brazil. They're significant, but UPI's scale is just on another level right now. It didn't just offer a digital alternative. It fundamentally changed how money moves for, well, an entire subcontinent. So the big question is, how on earth did they build this foundation? Where did it come from?
Yeah, to really get why UPI is such an innovation, you have to rewind a bit.
Yeah.
Think about India back in, say, 2015.
Okay.
The whole system was just dominated by cash. Our sources are pretty clear. Nearly 90% of consumer transactions were still happening with physical rupees.
90%. That's a massive drag on everything, isn't it? Economic efficiency, transparency, even just government finances. It just breeds inefficiency.
Oh, significant inefficiency. Cash means opacity, right? It means high risks, theft, counterfeit notes, plus huge logistical costs for banks just handling this stuff, transporting it, securing it.
Yeah, armored trucks, vaults.
Exactly.
Yeah.
And the digital options back then, they just weren't cutting it.
Right.
You had NFT, National Electronic Funds Transfer, but that was batch processed, slow.
Right, not instant.
Not instant.
That's right.
Then there was IMPS, Immediate Payment Service, which was 247, but, well, the systems didn't really talk to each other smoothly across different banks. And critically, neither was really built for the mobile-first world that was clearly coming.
And the costs were prohibitive, especially for small players, right? If you were a little grocery store, a Kirana shop.
Precisely. If you wanted to accept digital payments, you faced first the upfront cost of a point-of-sale machine, maybe, and then the killer, the ongoing merchant discount rate, the MDR.
That percentage fee on every transaction.
Yeah, and it could be anywhere from, say, 1% to maybe even 3% of the transaction value. For a small business on really thin margins, that just made going digital totally uneconomical.
So high costs, fragmented systems, and not everyone even had a bank account.
That's the other piece. Bank account penetration was still quite low, around 53% for adults in 2014, based on the data. So the whole market was just ripe for something completely new. A kind of public infrastructure.
A new digital railway, almost.
That's a good way to put it. They needed a new digital rail cheap everywhere, mobile first, that could bypass all those friction points, especially the high MDRs.
And crucially, this wasn't like a big tech company swooping in. This came from government vision.
Absolutely. The seed of UPI was planted firmly by the Reserve Bank of India, the RBI. They had this vision for a less cash economy. They understood fundamentally that for digital payments to really take off for everyone, The basic rails needed to be treated like a public good.
Public ownership for standardization and low cost.
Exactly. And the body they set up to build and run this rail is the National Payments Corporation of India, NPCI. Its structure is quite interesting.
Yeah, tell us about NPCI. It's not quite a government agency, not quite a private company.
Right, so it's a fascinating hybrid. NPCI is the institutional anchor here. It was set up back in 2008, and it's owned by a consortium of India's major banks. But, and this is the critical part, it's designed and operates as a not-for-profit managing retail payments infrastructure,
Yeah.
almost like a public utility,
Under the watchful eye of the RBI.
under very strict RBI oversight. So this structure tries to blend, the efficiency you might get from the private sector with the public interest goals of financial inclusion and system stability. Its job is to standardize everything, the APIs, security rules, compliance, making sure everyone plays by the same rules.
But UPI isn't just this isolated payment thing. It fits into a much bigger picture, this ambitious architecture called the India Stack. How does that whole stack support UPI?
Yeah, you really can't understand UPI without understanding the India Stack. It's essential context. Think of it as layers of interoperable digital public infrastructure. Yeah, right. Its whole purpose is to enable services at massive scale in three ways: presenceless, paperless, and cashless. UPI is the revolutionary cashless payment layer, but it sits on top of and relies heavily on foundational layers for identity and documentation.
Right, so let's start at the bottom. The identity layer, that's Aadhaar, right?
That's Aadhaar. It's the world's biggest biometric ID system. Over 1.3 billion people have this unique 12-digit number. Now, for the financial world, the game changer was integrating Aadhaar to enable real-time eKYC.
Electronics Know Your Customer.
Exactly. Think about what that means. Instant digital identity verification for hundreds of millions.
Yeah.
No paper forms, no visiting a branch, no bureaucratic delays. It makes onboarding someone into the financial system happen in seconds. That's absolutely foundational for inclusion at this kind of scale.
But whenever you talk about a giant centralized identity database like Aadhaar, alarm bells about governance and privacy start ringing. Our sources mention a key court case, Puddaswamy versus Union of India. What did that do?
Oh, that was crucial for building public trust. The Supreme Court, back in 2017, ruled that privacy is a fundamental right in India. Now, importantly, it upheld Aadhaar's legality, but it put significant constraints on its use.
Like what?
For instance, it couldn't be used for, say, pervasive state surveillance. Metadata collection was restricted, and it strongly affirmed that any Aadhaar authentication has to be based on user consent. Plus, the authority running Aadhaar UADI must follow strict security protocols. So this judicial oversight provided constitutional guardrails, which is vital when you're weaving DPI into something as sensitive as personal finance.
Okay, so identity is established and constitutionally bounded. Then the stack moves up to verification and documentation.
Exactly. The identity, validated via Aadhaar, feeds directly into the eKYC framework. This, according to the data, slashes the cost for banks and fintechs to bring on a new customer by over 80%.
80%, just by ditching paper.
Pretty much. No more field agents collecting forms, verifying them physically, storing them. It all happens digitally, cryptographically, in seconds. And it gets rid of the need for those wet signatures, physically signing documents, which used to be a huge hurdle, especially for people in remote areas or those with mobility issues.
And the paperless document side is handled by something called DigiLocker.
Right. DigiLocker is like a secure, trusted digital vault for official documents.
Right.
By 2025, it was holding something like over 6 billion verified digital documents, driving licenses, education certificates, vehicle papers, you name it.
Wow.
For banks or lenders, integrating with DigiLocker means they can get instant verified proof during onboarding or when assessing creditworthiness. It acts as this really critical trust layer, ensuring the digital documents are authentic, cutting down risk dramatically.
Okay, so we have identity with Aadhaar, payments with UPI, verified documents with DigiLocker. What's the next piece? The sources mention the account aggregator framework as the next evolution.
Yeah, the account aggregator, or AA framework, is really the next frontier for the India Stack. It completes what you might call the identity payment data triad. It's all about giving users secure, fine-grained control over sharing their own financial data.
How does that work in practice? Because data sharing is often where things get, well, leaky.
The beauty of the AA framework is its consent architecture. It's unified, meaning it works the same way across different providers, and crucially, it's revocable. You, the user, decide exactly what data to share, maybe just your last 6 months of bank statements, not everything. You decide who gets to see it, say, a potential new lender. And you decide for how long they can access it.
And the aggregator itself, does it see my data?
No, and this is critical. The account aggregator is designed to be data blind. It doesn't store or even see your financial information. It just acts as a secure, encrypted pipe, facilitating the transfer of data directly from the financial information provider, FIP, like your bank, to the financial information user, FIU, like that lender, based on your explicit consent.
So it enables things like instant loan approvals or personalized financial advice without me having to manually collect PDFs or share my bank login details.
Exactly. It unlocks huge potential for personalized services delivered instantly and securely.
Okay, let's tie this section together. The synergy that seems to be the magic of the India stack. What does having these distinct but interoperable layers of identity, docs, payments, data achieve that, say, just a really good proprietary payment app couldn't?
It achieves, as the sources put it, scalability and privacy by design. Look, a proprietary app might have a slick interface, sure, but it inherently creates a walled garden and wants to capture your data, lock you into its ecosystem.
Right.
India Stack, because it's digital public infrastructure, publicly governed, built on open standards, acts as a shared foundation. It's a level playing field. This layered design cuts down on duplication. Fintechs don't have to reinvent identity verification every time. It drastically lowers their entry costs.
Yeah.
And, maybe most importantly, it fosters systemic trust.
Because the government is providing the rails, not trying to monetize my every click.
In essence, yes. When UPI seamlessly plugs into Aadhaar for identity, eKYC for onboarding, DigiLocker for documents, and potentially AA for data sharing, you get financial inclusion built on a foundation that's resilient, incredibly low cost, and aligned with public goals. It allows the government to be a neutral platform enabler, fostering private innovation on top.
Okay, that foundation is clearly key. But now let's get into the actual engineering of UPI itself. We keep mentioning the scale, 14 billion transactions a month. That doesn't just happen with, standard bank tech from the 90s. How is it physically built to handle that load and still hit those 99.8% success rates?
Yeah, the resilience is definitely by design. It comes down to a pretty rigorous three-layer architecture.
Yeah.
The idea is to separate the different functions so that a problem in one area doesn't bring the whole house down.
Okay, layer one, the application layer. That sounds like what I see on my phone.
Exactly. This is the part you interact with. It's
Yeah.
managed by what are called third-party application providers, or TPAPs. Think Google Pay, PhonePe, Paytm, and the government's own BHM app. These apps handle the user experience, the UX, the interface, the notifications, language options, accessibility features, all that stuff. Now, crucially, the NPCI model deliberately decouples this user experience layer from the core infrastructure below.
What's the advantage of that decoupling?
It fosters massive competition and innovation at the consumer end. Anyone can build a slick, user-friendly UPI app as long as they follow NPCI's rules and technical standards. So you get this constant race to offer the best features, the easiest interface, while the underlying engine, the core processing, remains stable and standardized.
Okay, so layer two, interface and core processing. This is the NPCI managed switch. Sounds like the engine room, as you said.
It really is the operational heart. This layer, run centrally by NPCI, does the heavy lifting. When you initiate a payment, this layer figures out where to send the request based on the VPA, it validates the transaction details, handles the cryptographic authorization, checks against compliance rules,
In real time.
all in milliseconds. And to handle the load and ensure resilience, it uses a highly distributed architecture and things like asynchronous message queues.
What do the message queues do?
They're vital. Imagine one bank system is responding a bit slowly. Instead of the whole transaction just failing immediately, the NPCI switch can place the message in a queue and retry delivery for a short period. It smooths out temporary bottlenecks and prevents cascading failures. This layer is also where the directory for the VPAs is managed.
Yes, the virtual payment address, the VPA. You mentioned it earlier. It feels like such a simple but brilliant idea.
It really is elegant. The VPA is that standardized identifier, like your personalized email address for payments, your name at bank. What it does is completely hide your actual sensitive bank details, your account number, the bank's IFSC code.
Which is great for privacy and security.
Huge boost for both. For the user, it's super convenient to share your easy-to-remember VPA. For the system, you're never exposing those core banking details during the transaction initiation, either to the person paying you or the merchant. The NPCI switch acts like a secure phone book, translating that VPA into the correct underlying account details securely without revealing them externally.
Okay, application layer, TPAPs, core processing, NPCI switch. Layer 3 must be where the money actually moves, the settlement layer.
That's right. This layer is overseen jointly by NPCI and the RBI. Now, here's an interesting point. While you as a user experience the payment as instantaneous, the money appears in the receiver's account right away.
Yeah, feels instant.
The actual final transfer of funds between the banks happens using something called a deferred net settlement, or DNS model.
Hang on, deferred. How can it be deferred if I see the money instantly? What's happening there?
It's a clever balancing act between user experience and banking system stability. The real-time clearing part means your transaction is instantly authorized, confirmed back to you and the receiver. And the receiving bank usually makes the funds available in the beneficiary's account immediately based on the guarantee from NPCI.
Okay, so the banks trust the system.
They trust the clearing message. However, the actual movement of the bulk funds between Bank A and Bank B, the final settlement of all the debits and credits between them happens in short, predefined cycles throughout the day, often hourly. Banks maintain pre-funded accounts with the RBI to cover these settlements.
So they net everything out.
Exactly. They net out the obligations over that short cycle. This hybrid approach gives you, the user, that instant gratification and utility, while the underlying banking system manages liquidity risk and operational efficiency more effectively through this netting process.
Makes sense. Now, security. Moving trillions of rupees instantly. Security can't be an afterthought. It has to be baked in from the start. What are the absolute must-haves they built in?
Absolutely non-negotiable is multi-factor authentication, MFA. It always combines something the user has their registered mobile device with something the user knows their secret 6-digit UPI PIN.
Okay, the device part, you mentioned device binding. How does that actually stop something sophisticated, like SIM swap fraud, where a scammer tricks the mobile operator into porting my number to their SIM?
Device binding is a core defense. When you first register for UPI in your phone, the system generates a unique cryptographic hash. This hash essentially locks together your mobile number, the unique ID of your phone hardware, the IMEI, and the serial number of your SIM card.
Okay.
This unique fingerprint is stored securely by NPCI. Now, if a scammer manages to port your SIM to a different phone, any transaction they try to initiate will fail the device binding check. The hash generated by their phone won't match the one NPCI has on record for your UPI profile.
Clever. So the transaction gets blocked at the source.
Blocked right at the core processing layer before it even gets near your bank account.
And the UPI PIN itself, that 6-digit code feels like the keys to the kingdom. Where's that stored? Surely not on the TPA servers.
Absolutely not. That's a critical security principle. Data minimization. The UPI PIN is never stored by the third-party apps like Google Pay or PhonePe, not even in encrypted form.
So where is it managed?
The PIN creation and verification process is handled through a secure flow directly interacting with your issuing bank systems, mediated by secure APIs. When you enter your PIN on the app to authorize a payment, it's immediately encrypted right there on your device, using strong AES-256 encryption before it even leaves your phone.
Okay.
Then it's transmitted over a secure, mutually authenticated channel, typically TLS 1.3, directly to your bank for verification. The TPAY is just facilitating the secure entry and transmission. It never sees or stores the PIN itself. And of course, there are limits on PIN entry attempts to prevent brute force attacks. Too many wrong tries, and the account gets locked.
And the data transmission itself, you mentioned TLS 1.3, is everything end-to-end encrypted?
End-to-end encryption, E2EE, is the baseline standard here. UPI mandates robust encryption like AES-256 GCM for the actual transaction data, ensuring confidentiality, plus things like SHA 512 hashing for integrity checks, making sure the data hasn't been tampered with in transit.
Okay.
The communication channels between all parties, your app, the PSP bank, NPCI servers, the receiving bank, all use mutually authenticated TLS 1.3 sessions. This means both sides verify each other's identity cryptographically before any data flows. And it doesn't stop there. Sensitive data at rest, like transaction logs, is also required to be encrypted and often tokenized, replacing sensitive details with non-sensitive placeholders.
And this is all audited regularly?
Oh, yes. The entire infrastructure undergoes mandatory frequent vulnerability assessments and penetration tests, VAPT, conducted by independent security auditors, all aligned with the RBI's pretty stringent cybersecurity guidelines.
But security isn't just about building strong walls. With 14 billion transactions, that's a massive surface for attackers. How do they actively hunt for and stop fraud as it's happening?
Yet, static defenses aren't enough. This is where artificial intelligence and machine learning really come into play. NPCI, working closely with the RBI, operates a sophisticated payment fraud monitoring system, or PFMS.
PFMS. Okay. What does it do?
Think of it as a central brain, constantly analyzing transactional data streams from all the participating banks and apps in near real time.
What kind of AI is it using? How does it spot the bad guys in that ocean of data?
It primarily relies on unsupervised learning models. Why unsupervised? Because fraudsters are always coming with new tricks, so you need models that can spot anomalies, things that look weird, even if they haven't seen that exact type of fraud before.
Okay, so pattern recognition.
Exactly. Things like clustering algorithms group normal user behavior based on typical transaction times, locations, amounts, recipients, frequency, etc. Then deviations stick out. They also use more advanced techniques like autoencoders.
Autoencoders, how do they work for fraud?
An autoencoder is trained on vast amounts of normal transaction data. It learns to compress this normal data down to its essential features and then accurately reconstruct it back. Now, if a fraudulent transaction comes along, maybe a sudden, unusual large payment at 3 a.m. from your account to a brand new VPA you've never paid before, the autoencoder will struggle to reconstruct it accurately from its compressed form.
Because it doesn't fit the learned pattern of normal?
Precisely. It results in a high reconstruction error, which instantly flags the transaction as suspicious, triggering either an automated block or routing it for immediate human analyst review. And these models are constantly learning, retraining on new data to adapt to evolving threats like clever phishing scams or new types of malware.
Okay, so that's security breaches. What about system failure? Keeping something this complex running with 5 nines availability, 99.9999% uptime, that sounds incredibly hard. How do they achieve that high availability architecture?
It requires redundancy built in everywhere. You can't have single points of failure. The core infrastructure uses things like dual network routing paths, so if one connection goes down, traffic automatically reroutes. Critically, they operate geographically dispersed data centers.
Multiple locations.
Yes, Tier 3 standard data centers. And for disaster recovery, DR sites, NPCI mandates, they must be located over 500 kilometers apart from the primary sites.
Why so far?
To mitigate risks from large-scale regional events, think power grid failures, floods, earthquakes, you don't want your primary and backup sites to be knocked out by the same event. And crucially, transaction data is mirrored between these sites using synchronous replication.
Meaning no data loss if one site fails?
That's the goal: zero data loss, or RPO0. This level of resilience engineering is absolutely critical for what's designated as the systemically important payment system, following international standards like those from the Bank for International Settlements.
But even with all that, outages do happen occasionally. We hear about them. What do the postmortems usually find? Where are the weak spots typically?
Yeah, perfect uptime is almost impossible at this scale. The sources suggest that the common root causes are often less about the core NPCI infrastructure failing, and more frequently things like application-level issues at one of the major TPAPs causing overloads, database bottlenecks at specific banks during peak times like salary days.
Right. Everyone checking their balance at once.
Exactly. Or sometimes configuration errors, like a DNS misconfiguration that might briefly affect routing for several payment providers.
NPCI's response protocol is pretty robust, though. Automatic failover systems kick in to redirect traffic, but it's always followed by a mandatory detailed postmortem audit involving everyone who is impacted, the TPAP, the affected banks, and PCI itself.
Learning lessons each time.
The key lesson seems to be that true resilience isn't just about backup hardware. It's increasingly about proactive capacity planning and predictive analytics, anticipating the surges before they hit. The RBI has actually formalized this with its framework for incident reporting, demanding better forecasting. One last engineering point: interoperability. UPI mandates open APIs so everyone can connect, but you've got hundreds of banks, many with older legacy systems, all trying to plug into this super fast modern system. That sounds like a recipe for friction.
Oh, it absolutely is a constant challenge. You call it interoperability friction. And that's exactly right. You see gaps because, Bank X might have slightly older back-end software than Bank Y, or their API response times might be a fraction slower under load.
Then that can cause issues.
It can lead to things like delayed payment confirmations, maybe a debit happens but the credit is slow, or temporary confusion in settlement. It undermines that seamless experience. So NPCI tackles this aggressively with something called the Integration Audit Program, or IAP.
Auditing the bank's connections.
Essentially, yes. They mandate regular, often quarterly, validation of all the bank's API endpoints against NPCI standards. They check for compliance, latency benchmarks, error rates, enforcing uniformity. And, crucially, they enforce very strict turnaround times, or TATs, for resolving any disputes or processing reversals, usually P+1 day, meaning by the next business day.
So strict rules and quick fixes.
That strict operational discipline is what ultimately maintains public confidence that the system, despite its underlying complexity, feels seamless and instant nearly all the time.
Okay, let's shift gears now quite significantly into the economics of UPI, and we have to start with probably the most debated policy decision, the zero merchant discount rate, or zero-MDR policy that came into effect in 2019.
Ah, yes, the zero-MDR, definitely controversial.
You mentioned earlier that high MDRs were a major barrier for small merchants, so getting rid of them entirely sounds fantastic for adoption and inclusion, right? But what's the tension point? Where's the problem?
The tension is fundamentally about financial sustainability. You're right, the zero-MDR policy was, in many ways, a masterstroke for driving inclusion. It instantly made accepting digital payments completely free for merchants, especially the smallest ones. That's a huge reason why we saw that explosion to 50 million merchants adopting UPI QR codes.
It removed the biggest cost barrier.
Completely. But by eliminating that merchant fee, the government also eliminated the primary traditional revenue stream that pays for the entire infrastructure. The PSPs, the payment service providers like the banks and the TPAPs and the acquiring banks who onboard the merchants, they suddenly had no direct income from these transactions.
Right. So if the transaction is free for the merchant and it's free for me as the customer sending money, who's actually paying for all those servers, the security systems, the 24/7 monitoring, the fraud prevention AI we just talked about? Those things aren't free.
Not at all. Those costs are substantial, running the tech, meeting compliance rules, network charges, API call fees, and significantly covering the costs of fraud when it does happen. We're talking billions of rupees annually across the ecosystem. Since they can't charge the merchant for a standard UPI payment, the revenue model had to completely pivot.
Okay, pivot to where? How do they make money now, or at least cover costs?
It shifted primarily towards cross-selling other financial products around the payment transaction. The PSPs, the apps, they now use the UPI platform and the customer relationship it gives them to offer adjacent services.
Like what?
Things like small, instant microloans, often based on the user's transaction history, which gives a creditworthiness signal. Or selling microinsurance policies or mutual fund investments. They try to monetize the user relationship and the data insights rather than the payment transaction itself.
So using the free payment rail as a customer acquisition channel for other paid services.
Essentially, yes, that's one part. The other major part is direct government support. The government recognized that zero-MDR, while great for inclusion, created this viability gap. So they step in with subsidies.
Actual cash injection.
Yes. For example, in the 2024-25 budget, the government allocated around INR 2,600 crore, that's roughly $300 billion, under a scheme specifically designed to reimburse banks and PSPs for the costs they incur processing low-value UPI transactions, particularly those involving RuPay debit cards and BHM UPI.
Okay, but relying on government subsidies to keep a critical piece of national infrastructure running, doesn't that feel a bit precarious? What if budgets get tight or political priorities change?
That is the absolute core of the sustainability debate. It's a constant discussion. While the subsidies are seen as necessary right now to maintain that zero-cost entry point for the poor and for micro merchants preserving the inclusion gains, it does tie the operational health of the payment system to the government's fiscal situation and policy whims.
So it's a trade-off.
It's a very clear policy trade-off the Indian government has made. Prioritize mass adoption and financial inclusion now, even if it means subsidizing the operational costs, over allowing the market to set prices via MDR, which would likely exclude many smaller players again. The industry is exploring other models, maybe charging very small fees for high-value corporate transactions or for value-added services. But for now, this mix of cross-selling and direct subsidy is the economic reality holding UPI together.
Fascinating tension. But despite that friction, the policy clearly worked in achieving its main goal, deep financial inclusion. The sources often talk about the success of the Jam Trinity here.
Yes, the Jam Trinity was the perfect setup for UPI success. It stands for Jan-Dhan bank accounts, Akadar identity, and mobile phone connectivity. The government made a massive push, especially with the Pradhan Mantri Jan-Dhan Yojana, PMJDY scheme, to open basic bank accounts for almost everyone.
How many accounts are we talking?
By 2024, over 500 million Jan-Dhan accounts had been opened. Now combine that basic bank account, Jan-Dhan, with a verifiable digital identity, Aadhaar, and the increasing penetration of mobile phones. And you have the perfect ingredients for UPI adoption.
And the data shows it worked.
Unambiguously. The data indicates that over 60% of these Yandan account holders, many of whom were previously completely outside the formal banking system, are now active UPI users, using it at least monthly. It wasn't just about giving people an account. UPI provided a simple, free way to actually use it. It turned passive access into active financial participation. And, as a side benefit, it made government welfare transfers much more efficient.
Right. But inclusion isn't just about having an account if the tech only works for people in cities with smartphones. What about the millions in rural areas with patchy internet, or people who only have basic feature phones? How did UPI reach them?
This is where UPI's design gets really clever, I think, moving beyond just the standard smartphone app model. They tackled the connectivity issue first with something called UPI Lite, introduced in 2022.
UPI Lite. How does that work offline? Payments usually need the internet, right?
Right. UPI Lite lets you preload a small amount, say up to INR 2,000 from your bank account, into a secure, encrypted on-device wallet within your UPI app. Then you can make small value payments currently up to INR 500 per transaction completely offline.
How?
The transaction happens locally on the device, debiting the on-device wallet. No real-time connection to the bank or NPCI is needed at the moment of payment. You only need to connect occasionally later to top up the wallet or reconcile the balance with your main bank account.
So perfect for areas with spotty mobile networks.
Exactly. It ensures transaction reliability for everyday small purchases, like buying vegetables or tea, even if the network is down or congested. It keeps commerce flowing.
Okay, that handles low connectivity. But what about people who don't even have a smartphone? The feature phone users, or maybe elderly people who find apps confusing.
That was the next big barrier, and they addressed it with UPI 123 Pay. This was a really significant step for digital equality, launched specifically to bring UPI access to feature phone users. It completely removes the need for a smartphone or an active mobile internet data plan.
How? What are the methods?
It offers several ways. One is through IVR interactive voice response.
Like calling a number and using the keypad?
Exactly.
Yeah.
A user with a basic feature phone can call a standard toll-free number. An automated voice guides them through the payment process in their chosen language. They can select the recipient, enter the amount, and authenticate using their device binding and entering their UPI PIN via the phone's keypad.
Simple enough. What else?
There are other methods too, like making a missed call to a specific number pre-assigned to a merchant to trigger a payment request, or even using proximity sound technology where the phones emit secure audio signals to exchange payment details over very short distances.
Wow. So truly trying to bridge that digital divide caused by device limitations.
Absolutely. It ensures that the benefits of digital payments reach even those reliant on the most basic mobile technology, which is critical in a country like India.
And beyond the tech itself, accessibility also means language, right? India has incredible linguistic diversity, 22 official scheduled languages.
Huge factor. A system can't be truly inclusive if it only speaks English or Hindi. So UPI apps are mandated to comply with accessibility standards, like the Web Content Accessibility Guidelines, WCAG 2.1. This includes things like proper support for screen readers like TalkBack or VoiceOver for visually impaired users, and features like haptic feedback.
And the language translation.
That's handled through integration with a government initiative called the Pashini Project. Pashini aims to build AI-based language translation tools for all major India languages. By integrating with Pashini APIs, UPI apps can offer their user interfaces in potentially all 22 scheduled languages. This massively lowers the barrier to entry, increases user comfort, and reduces the anxiety some people feel when adopting new financial tech.
Okay, let's talk impact. We've got the tech, the inclusion features. What actually happened on the ground when cash started to fade? Let's look at small businesses first, the micro enterprises.
The impact there seems quite dramatic based on the studies we reviewed. Those small retailers, the local kirana stores, the street food vendors, they really embraced UPI, mainly because of the zero-MDR and the simple QR code system.
And it helped their business.
Significantly. The data suggests these small vendors reported, on average, a 12 to 18% increase in their turnover after adopting UPI.
Why such a big jump? Just convenience?
It's a combination of factors. Yes, convenience for customers is part of it, but for the vendor, it also means instantly streamlined bookkeeping, no more manual tallying of cash. It means instant liquidity. The money is in their account right away. And importantly, it reduces the risks and hassles of handling cash. No worries about theft, dealing with exact change, or accidentally accepting counterfeit notes.
And critically, all those digital transactions create a data trail where maybe none existed before.
That is perhaps the most transformative part. This digital transaction history becomes a powerful credit surrogate. Think about it. These micro-entrepreneurs often operate informally, lacking the traditional collateral or documents banks usually want for loans.
Right, no formal pay slips or property deeds.
Exactly. But now they have a verifiable digital record of their daily cash flow via their UPI transactions. This allows fintech lenders, small finance banks, and NBFCs, non-banking financial companies, to assess their creditworthiness much more accurately and offer them small, formal business loans.
So it unlocks access to capital based on actual business activity.
Precisely. It allows them to invest, buy more stock, maybe expand slightly, enabling financial mobility that was much harder to achieve when everything was just invisible cash. It's data-driving opportunity.
What about gender equity? Sometimes digital systems can accidentally leave women behind. How has UPI impacted women users?
The data here is actually quite positive and suggests UPI is helping narrow the digital financial gender gap. Reports indicate women now make up around 36% of active UPI users. That's a really substantial jump from about 28% back in 2019.
Why the increase?
The ease of use and the transparency seem to be key factors. UPI is proving particularly useful for women involved in self-help groups, or SHGs, which are very common in India. The platform allows these groups, often women-led, to manage their collective savings and loan activities transparently. They can track contributions instantly, disperse small loans among members, and manage repayments, all digitally. This really enhances financial autonomy and empowers women within these community structures.
And finally, the impact on the government itself. Moving all those welfare payments must be way more efficient now.
Oh, it's been revolutionary for public finance administration. UPI is now deeply integrated into India's direct benefit transfer, or DBT, system. This is used for transferring all kinds of welfare payments and subsidies, pensions, scholarships, support for farmers, cooking gas subsidies, you name it.
How does it work?
Instead of funds flowing through multiple layers of bureaucracy, the government can transfer the money directly from the Treasury into the beneficiary's bank account, which is linked and authenticated using their Aadhaar identity and verified through the banking system.
Cutting out the middlemen.
Exactly. This dramatically reduces opportunities for leakage, corruption, and delays that were common with older manual distribution systems. It increases the speed of delivery, enhances fiscal transparency for the government, and ensures the intended recipient actually gets the full amount. It's a huge win for efficient governance.
Okay, so UPI clearly nailed the domestic market by focusing on public good, inclusion, low cost. Now, the narrative is shifting. We're hearing a lot about UPI going global, being exported as a kind of digital diplomacy. How is India actually positioning this technology internationally?
Yeah, the global push is becoming quite significant. It's being spearheaded by a dedicated entity called NPCI International Payments Limited, or NIPL. It's a subsidiary of NPCI. NIPL's job is to take the UPI technology, stack the blueprints, the standards, and also the governance model, that public-private partnership approach, and offer it to other countries. But the framing is really important here.
Also,
NIPL consistently emphasizes that they are offering DPI partnerships, not platform dominance. What that means is they're not trying to export a single Indian app like BA-Sham and make everyone use it. Instead, they're offering the underlying blueprint, the expertise, the integration framework so that other countries can build their own sovereign, interoperable, fast payment systems based on the UPI model but controlled domestically.
interesting distinction. So are they giving away the tech open source, or is it more like a consulting and licensing deal? How does the actual transfer work?
It seems to be a bit of a mix. The core technical specifications, the API standards, those are generally shared openly, consistent with the principles of open digital public infrastructure. However, the implementation support, the governance consulting, the technical assistance needed to actually set up and run a national-level payment switch based on this model that's typically offered as a paid service or a partnership arrangement.
So NIPL gets revenue, but the partner country keeps control.
That seems to be the model. It allows NIPL to have a sustainable business model while ensuring the partner country retains complete digital sovereignty over its own payment data and critical infrastructure. It's a collaborative pitch, not a colonial one.
And where have we seen this model actually take root? Where are the concrete examples of UPI going international?
The most prominent early success was the linkage with Singapore's national fast payment system, PayNow. That went live in 2023.
What does that link enable?
It allows for instant, low-cost cross-border remittances between India and Singapore. People can send money just using a mobile number or a VPA, completely bypassing the old slow and expensive correspondent banking system or wire transfers, it's a huge benefit for migrant workers and families.
Okay, Singapore. Where else?
We're seeing strong traction in South Asia as well. Bhutan was actually the very first country to adopt UPI's QR code standards for merchant payments. And Nepal has implemented a version of the system to boost its own domestic digital payments and regional financial inclusion efforts.
And beyond direct system linkages, what about just getting merchants in other countries to accept UPI payments from Indian travelers?
That's expanding too, strategically. There are agreements in place in the UAE working through local banks there, and perhaps most symbolically, UPI acceptance was launched in France in 2023, initially targeting Indian tourists.
I heard about the Eiffel Tower accepting UPI.
That's right, through a partnership with the Lyra network. You can apparently use your Indian UPI app to pay at the Eiffel Tower and other select merchants in France. It marks UPI's entry into the European market, showing it can work across borders. And NIPL is reportedly in active talks with numerous other countries across the Middle East, Africa, and Southeast Asia. Many nations are looking for ways to rapidly build low-cost, inclusive payment systems, and the UPI model is obviously very attractive.
What's the bigger picture goal here for India strategically in exporting UPI?
On one level, it directly supports global development goals, particularly the UN Sustainable Development Goal target of getting global remittance costs down below 3%.
Right.
These direct UPI linkages are way cheaper than traditional methods.
Right.
But on a broader geopolitical level, well, it positions the UPI model open, collaborative, focused on digital sovereignty, as a potential alternative to the decades-long dominance of the big Western-based card networks, Visa and MasterCard.
So a challenge to the established players.
Potentially. It offers developing nations a pathway to build and control their own critical payment infrastructure domestically, rather than relying entirely on foreign proprietary systems. It's about fostering a more pluralistic, global digital finance landscape.
Okay, this is where it gets really fascinating looking ahead. Beyond just making payments faster, what does the next generation of UPI look like? The sources talk about UPI 3.0, 4.0. What's the vision?
The vision seems to be evolving UPI from just being a payment rail, albeit a very efficient one, into something much more fundamental, a kind of ubiquitous financial fabric woven into the digital economy. UPI 3.0 brought features like recurring payments, e-mandate, and overdraft facilities, but the conceptual leap with UPI 4.0 and beyond is really about embedded finance.
Embedded finance. What does that mean in plain English? How does my payment app become a fabric?
It means financial services payments, yes, but also credit, insurance investments become seamlessly integrated inside other non-financial applications and workflows. The prime example everyone talks about is credit on UPI.
Credit on UPI, how would that work?
Imagine your bank pre-approves you for a small line of credit, say INR 10,000, and links it directly to your UPI VPA. Now, when you go to buy something online or in a store, you select UPI as the payment method. But instead of choosing to debit your savings account, you could choose to instantly draw down on that pre-approved credit line to make the payment.
So instant point-of-sale credit delivered through the UPI rails.
Exactly. No separate loan application, no delay. It transforms the payment system into a real-time credit delivery mechanism. You can see similar potential for embedding microinsurance purchase options right at the point of sale or simplifying investment top-ups. Banking functions start to become invisible, just embedded where you need them.
And what new technologies are they looking at to power this even faster, more embedded future?
Well, 5G connectivity is a big one. With the ultra-low latency that 5G promises, they're apparently targeting transaction processing times under 100 milliseconds. It opens up possibilities for expanding UPI into the Internet of Things, or IoT.
Like my fridge ordering milk.
Maybe eventually. But more immediately, think about device-to-device payments. Paying automatically from your wearable device, seamless NFC tap-and-go payments becoming even faster, or even your car paying for tolls or parking automatically by integrating UPI with the existing FASTag system. That kind of machine-to-machine economy needs near instantaneous transactions.
And what about the core ledger technology? Is blockchain or distributed ledger technology, DLT, part of the future vision? UPI seems pretty fast already.
Yeah, that's a really interesting point. The exploration of DLT, from what the sources suggest, isn't primarily about making payments faster.
Yeah.
UPI's centralized architecture is already incredibly fast for simple transfers. It's more about leveraging DLT for its other properties, programmability and creating immutable, trustworthy audit trails.
Programmability, like smart contracts.
Exactly. Imagine using DLT to enable smart contracts on top of UPI for more complex transactions. For example, an automated escrow payment in a business deal. Funds are locked via UPI, but only automatically released to the supplier when a specific condition is met, say, a shipment's arrival is confirmed by an IoT sensor feeding data onto the ledger.
So moving UPI beyond just sending money to automating agreements and workflows.
Precisely. It can move UPI from being just a payment facilitator to becoming a kind of automated governance layer for things like supply chain finance or complex B2B settlements, leveraging the trust and immutability of DLT.
Okay, final area, policy foresight. This system is getting incredibly sophisticated, which also means the risks evolve. How are they planning for future threats, things we might not even fully understand yet?
Security is definitely moving beyond static defenses towards more dynamic AI-driven approaches. They're implementing things like behavioral biometrics and continuous authentication.
What does that mean?
It means the system isn't just checking your PIN once. It's constantly passively assessing your risk profile in real time, based on how you interact with your device, your typing speed, how you hold the phone, your location patterns, the time of day. If your behavior suddenly deviates significantly from your established norm, even subtly.
Like if someone else is using my phone.
Exactly. The system's risk score for that session immediately increases, potentially triggering requests for additional verification steps, like facial recognition or an OTP, before allowing a high-value transaction. The idea is to catch sophisticated attacks like social engineering or malware that might have gotten past the initial login.
And thinking really long term, what about the elephant in the room for all cryptography? Quantum computing.
Yes, the potential for future quantum computers to break today's standard public key encryption, the RSAs and ECCs that underpin most secure communication, is definitely on the RBI's radar. They acknowledge it as a critical, albeit long-term, risk.
So what are they doing about it?
They are actively exploring and planning for the eventual transition to what's called quantum-resilient payment infrastructure. This means researching and testing new cryptographic algorithms post-quantum cryptography, PQC, that are believed to be resistant to attacks from both classical and quantum computers. It involves long-term planning for migrating to future-proof its security against that potential paradigm shift in computing power, maybe decades from now.
And all this evolution, embedded finance, IoT, AI security, quantum resistance, it's all happening within the bigger picture of India Stack 2.0.
Precisely. UPI 4.0 and its future iterations aren't developing in isolation.
Right.
They're designed to integrate tightly with the broader vision for India Stack's next generation, often referred to as Open Digital Ecosystems, or ODEs. The idea is to extend that layered, interoperable, consent-based model beyond just finance. Imagine a federated data architecture where, with your explicit consent managed via frameworks like the account aggregator, you could securely share relevant data across different sectors, like linking your health records for insurance underwriting, or using digital education credentials for job applications, or accessing digital land record for property transactions.
So connecting all the digital layers, identity, payments, and data across various domains.
Exactly. All anchored by that core philosophy of open standards, interoperability, and user control over their own data via consent. It positions India Stack with UPI as a key pillar, as this globally significant reference model for how to build composable digital public goods that empower citizens and foster innovation, moving way beyond just making payments more efficient. Hashtag tag outro.
Wow. Okay, we have covered a lot of ground there, from the nitty-gritty engineering of the three layers, the VPA, the security, all the way to the really complex, frankly, economics of that zero-MDR policy and its impact on inclusion. What really stands out to me, pulling it all together, is that the UPI story, it's not really about venture capital funding or some slick proprietary software built in a garage. It feels much more like a story about deliberate public policy, about building institutional trust primarily through that NPCI RBI governance model, and this deep, almost philosophical commitment to open standards and interoperability.
I think that's absolutely right. It's a powerful proof, really, that when you design digital public infrastructure specifically for inclusion, making it essentially free at the point of use for basic transactions, ensuring access is near universal, it can achieve a scale, a level of resilience, and frankly, a pace of innovation that purely proprietary, profit-driven models often struggle to match.
Yeah.
That strategic choice early on to decouple the user-facing applications, the Google Pays, the Phone Pays, from the neutral ownership and operation of the core infrastructure by NPCI, that created this incredibly vibrant, competitive ecosystem on top, which ultimately benefits everyone.
So thinking about this massive success story, What does it all mean for you, the listener watching this unfold, if you really consider the implications of India now exporting this model, a technology built on open access, zero fees for the smallest merchants, and this principle of digital sovereignty? It does raise a pretty powerful final question, doesn't it?
It really does. And it's a question that goes beyond just tech or finance. It pushes into global policy and maybe even geopolitics. You have to ask, how will the growing adoption of the UPI model or similar DPI approaches inspired by it start to challenge the, well, almost century-long dominance of the established, proprietary, mostly Western-based card networks?
Visa, MasterCard.
Exactly. As more countries, especially in the developing world, adopt this kind of open public utility approach to payments, could we be witnessing the beginning of a fundamental shift in the global financial plumbing? A shift away from centralized corporate control towards more collaborative development and national sovereignty over critical digital infrastructure. That potential transformation from just a domestic success story to a genuine geopolitical disruptor, that might be the ultimate long-term significance of India's big DPI experiment.
A really powerful thought to leave things on. Thank you for joining us on this deep dive.